Today, I'm going to help you understand how to work out a mortgage strategy that best suits your situation. When most people buy a home, they have a down payment and the bank loans them the rest of the money. The bank then tells them that, hey, this is how much you're going to pay every month, and the mortgage term is for 25 years or maybe up to 30 years. Most people just go with the flow and every 2 or 5 years go back to their mortgage broker to try and get a new rate because their fixed rate is probably up. This is an easy way for you to let the bank decide on how you pay off your mortgage, but you can work out a strategy that can actually help you save a lot of the interest that you'll be paying the bank. Let's use real numbers. You have a mortgage of £300,000 over 25 years, and your interest rate that you got from the bank in this day and age is 4.65%. Your monthly payment that has been worked out by the bank is 1,693. Fine, people know that, but there is one number that people hardly ever focus on that I want to bring to light. 207,943. This is the number that you're going to pay to the bank in interest over the 25-year period that you have borrowed 300,000 from the bank. You borrow 300,000, but in total you're going to pay 507,000 over that 25-year period. That includes the 300,000 that you borrowed and 207,000 that is interest payments that you're going to make to the bank. This video is going to help you understand how to reduce, redirect, or even bother whether it's worth paying down some of this amount to reduce the interest that you're going to pay over the 25-year period of your mortgage. There is no single right answer, but there is a framework that you can work around that can help you optimize your outcomes for your mortgage payments. Before any strategy, you need to understand what is actually happening with your mortgage payments. So that 300,000 that you borrowed from the bank, out of which they are telling you that you're going to be paying 1,693 every month, that 1,693 in month one is a different 1,693 in the last month of your 25-year period. In the first month, 1,163 goes to pay off your interest. Only 530 is reducing the 300,000 that you borrowed from the bank. By the last month, that is maybe in 25 years when you are paying off your mortgage, almost all that 1,693 is going straight to pay off the principal and not much going into interest. This is called front loading, and that is why the first 10 years of your mortgage payments feel like it's barely moving the needle. Look at it this way. By year 8, you would have paid about £100,000 in cumulative interest, but your original loan of 300k would be left with £238,000. You've only cleared £62,000 of the debt. The rest just went to the bank as their profit. But by year 16, which is about more than halfway through the term, you would have paid a total of £174,000 in interest, but you'll still have £149,000 left to finish paying off your mortgage. This is the context for every decision that follows. Overpaying your mortgage seems like the most sensible thing to do. And sometimes it is, but before you start overpaying your mortgage, I need you to ask yourself 5 questions. Question 1. Does your mortgage allow overpayments? Most fixed mortgages allow you to overpay up to 10% of the balance of the mortgage, and beyond that, you will be charged a penalty if you decide to overpay that mortgage. That penalty could be between 1 to 5% of the balance of the mortgage. So check your mortgage documents first to know what restrictions are in place before you decide to start overpaying your mortgage. The second question I would say to ask yourself is, do you have an emergency fund? This is something that's not really highlighted. When you overpay your mortgage, that's money that has gone into the bricks and mortar of the property. That money doesn't easily come out of the property. So before you decide to pay, make sure that you have emergency fund that will come in play when you need money urgently for something. The amount that's mostly advisable to have in your emergency fund is between 3 to 6 months of your living expenses. With that secured, you are in a more comfortable place when you overpay your mortgage, knowing well that that money that's logged in that property may not be coming back anytime soon when you need it. The third question to ask yourself before you start overpaying your mortgage is, do you have other expensive debt? 4.65% on your 300,000 mortgage is relatively cheaper compared to what you would have on your credit card and what you would have on your car loan. Those expensive debts need to go away first. That extra money that you are putting in your mortgage is probably costing you more because it's not redirected into other debts that are costing you more. Before you start paying down your mortgage, you need to understand that other debts that could be more expensive need to be wiped down first. The fourth question to ask yourself before you start overpaying your mortgage is, are you maximizing your tax advantage accounts? Your ISA gives you a 20,000 allowance tax-free. Your pension is actually even more powerful. Contributions get tax relief at your marginal rate. Let's say you're a higher rate taxpayer. Overpaying a mortgage instead of contribution to a pension, you are leaving about 40% of HMRC top-up on the table. That is almost impossible to beat with mortgage overpayments. The last question to ask yourself before you start overpaying your mortgage is, what is the rate on your mortgage and how long do you have left? The lower your mortgage rate, the weaker the case for overpaying your mortgage. At 4.65% mortgage rate, every pound you pay saves you 4.65p a year in guaranteed interest. That is a meaningful return, but it's actually not an exceptional return. We will come back to this when we talk about an inflection point later in this video. If you've answered all these 5 questions correctly and honestly for yourself, and you're leaning towards overpaying your mortgage, this is how it's going to look like. Still using my 300,000 mortgage example with 4.65% interest, let's dive into it. An extra £100 a month into your mortgage payments saves you £23,442 in interest and pays off your mortgage 2 years, 5 months earlier. An extra £200 payment into your mortgage every month is going to save you £41,905. And you're going to be mortgage free in under 19 years compared to the 25 years that you initially planned for. These are real guaranteed returns. The question now is that the best use of that money? To answer this question, I need to introduce you to a concept called LTV, loan to value. It is simply what you owe as a percentage of what your home is worth. And it's the single most important number in this whole mortgage strategy because it determines what rate you qualify for. At 90% LTV, which is where most first-time buyers start from, you are paying the highest mortgage rates. The bank sees you as the riskiest borrower. You have 10% equity. That means that if the value of the property falls down 11%, you are going to be in negative equity. Each time you cross a threshold, you unlock a better rate. So if your loan to value or LTV moves from 95% to 85%, you unlock a better rate than what you used to have. Same goes for 80%, 75%. Your mortgage rate can now be unlocked at a better rate than what you are actually paying. But the 2 most important numbers when it comes to LTV that you should never forget is 60% LTV and 50% LTV. 60% LTV is where the best standard rate tiers sit. The banks are very comfortable lending at 60% LTV. The risk is low, your equity is substantial when you hit this particular point. And on a standard repayment mortgage, you will likely get to that level around year 14 after you started your mortgage journey. You want to be actively shopping your mortgage rate around that point. 50% LTV is the inflection point. At this point, your mortgage that was 300,000 when you started is now 150,000. Half of the property is yours. Your risk is significantly lower and the bank's risk is significantly lower. At this point, the mathematical case for directing your spare cash into investments is very strong. But the other thing is 50% LTV unlocks something more that people actually don't know. It unlocks the opportunity to lock in an interest-only mortgage rather than a repayment mortgage. At a lower LTV, the lenders actually offer to switch to an interest-only mortgage. Your monthly payment drops from 1,693 to 1,163 if you decide to go in for an interest-only mortgage. That now frees about £500 that can be redirected into investments. Whether you take that option of going down the interest-only route to redirect the extra 500 that is not going into your mortgage depends on what you use that extra £500 for. Let's work on the math. So let's assume that you decide to invest in a global index fund. The one I usually talk about is a FTSE All-World Index. The assumption here is every year that FTSE All-World Index would return 7%. That is an assumption that is not guaranteed. If you had extra £300 a month, your portfolio by year 25 would be £243,000. But if you decided to redirect that £300 into your mortgage by overpaying and your interest rate was 4.65%, you would save yourself £56,000 in interest, and you will pay off your mortgage at around 19 years instead of 25 years. But you need to remember that the 7% that we are assuming you get in the stock market is just an assumption. The 4.65% on your mortgage is the one that is guaranteed. So your decision to go either way depends on your appetite for uncertainty. If you're about 35 years old with stable income, investing looks like the winner. If you're about 55 years old with 10 years to retirement and you want certainty over your housing costs, overpaying gives you something that no investment can, which is a guaranteed roof over your head regardless of what the market does. So let me pull this all together for you, a decision framework that you can actually use. 1. Clear expensive debt first. 2. Build your emergency fund. 3. Maximize your tax advantage accounts. 4. Check your loan to value. Above 75% loan to value, overpaying to reach your next threshold unlocks a better rate. This is often worth prioritizing. Between 75 and 65% loan to value, this becomes a balanced decision and a personal preference. And below 50% loan to value, investing most likely wins over a long-term horizon. Step 5. Check your rate versus the expected investment return. If your rate is above 5%, overpaying is strong because your guaranteed return that you are getting from your mortgage is very close to what we've seen equity market return historically. If your rate is between 4 to 5%, it's now balanced. Depending on your personal preference and risk appetite, you can choose to overpay or you can choose to invest in the stock market. If your rate is below 4%, investing wins if you've got a timeline beyond 10 years. The goal of owning a property is not necessarily to have your mortgage paid off. The goal is to make the best decision that best suits your specific numbers and your tolerance for uncertainty or risk. If this was useful to you, share it with someone who's about to sign their mortgage document or already has a mortgage. The conversation that most people have with their mortgage brokers is around how they can get a cheaper rate. None of the conversation has an all-rounded approach that helps you to optimize your returns. It's been Abigail. Give me a thumbs up if you like this video and let me know in the comments on your thoughts of overpaying your mortgage or investing in the stock market. Catch you later.